We have a super hawkish skip. A unanimous Fed, no dissents, leaves the benchmark rate at 5 to 5.25%. However, the new dot plot shows a new terminal rate of 5.6%, which would be 225 basis point moves or at least 150. 12 of the 18 members of the committee see rates at that level or above. One sees 6.25%. 4 see rates moving up only 25 basis points, but only 2 see no change between now and the end of the year. In their statement, the officials say, holding the target range steady at this meeting allows the committee to assess additional information and its implications for monetary policy. But the very next sentence leads us into it with saying, instead of saying, in determining the extent to which additional firming may be appropriate, it now reads, in determining the extent of additional policy firming that may be appropriate. There are also significant changes to the economic assumptions. Unemployment this year projected to reach only 4.1%, down from 4.5%, 4.5% next year, and in 2025, down from 4.6%. Growth revised up this year to 1% from 0.4%, and lowered by 0.1 in the next 2 years. PCE inflation forecast at 3.2%, down from 3.3% this year. Core PCE is revised up this year to 3.9 from 3.6. There are almost no significant changes in inflation for the next 2 years. The federal funds rate will be cut, but not until next year, the summary shows. It will be a big cut as well, a full percentage point in 2024, going to 4.6% by the end of next year. They see rates falling to 3.4% in 2025. The statement says the economy has continued to expand at a modest pace, but job gains have been robust and inflation remains elevated. While the banking system is sound and resilient, they do expect tighter credit conditions will weigh on economic activity, hiring, and inflation. The extent of those effects remains uncertain, it says. And finally, there are no changes to QT, the $95 billion a month roll-off, to repo or reverse repo rates or to counterparty caps.